All right, welcome Badgers. Thank you for joining us today for Homecoming 2021 and specifically this first time homebuyer session. My name is Chris Ventura and I hold a BA in Political Science and History and a Master's of Education in Leadership and Administration from Brock University in 2012 and 2017 respectively. I'm your co-host today and I'm representing the Brock University Alumni Association Board of Directors. During this virtual homecoming, we have alumni joining us locally from across Canada and internationally. Knowing this, we would like to begin today's event with a land acknowledgement, where we recognize the Indigenous communities that originally inhabited this land, where we all come together today. So Brock University acknowledges the land on which we gather is the traditional territory of the Haudenosaunee and Anishinaabe people, many of whom continue to live and work here today. This territory is covered by the Upper Canada Treaties and is within the land protected by the Dish with One Spoon Wampum Agreement. Today, this gathering places home to many First Nations, Métis, and Inuit people, and acknowledging reminds us that our great standards of living is related to the resources and friendship of Indigenous people. I would encourage you to research the land on which you live, find out its treaty history, and learn about the people who arrived and or who have been occupying this land since time immemorial before the arrival of European colonists. There are a couple of housekeeping items I would like to mention before we get started. This webinar, including all others throughout Homecoming, will be available for viewing on demand in the Homecoming Hub. I encourage all of you to explore the Homecoming Hub and following this session and add any events to your agenda that you may have missed, as well as learn more about the perks and benefits that come with being a Brock graduate. Finally, we encourage you to type any questions you may have through the presentation in the chat box. Simply click chat at the bottom of your screen to access the chat box, and we'll address your questions at the end of the presentation. With those housekeeping items out of the way, I'd like to introduce our guest speakers who will be guiding us through the process of purchasing your first home. Our first speaker is Kyle Ellsworth, a senior wealth advisor from Meridian Credit Union and Credential Securities, who has specialized in investment and financial planning for 10 years. Kyle graduated from Brock University in 2012 with a Bachelor of Business Administration and Finance. Second, we have Tina Ferrari, a mortgage specialist who has been with Meridian Credit Union for 21 years. She went from starting as a part-time teller to her current role, a dedicated mobile mortgage specialist. Her career focuses on helping people with mortgages and home equity lines of credit. And finally, we have Brad Martin, who graduated from Brock University in 2005 with a Bachelor of Arts in English Literature, minoring in Geography. He later completed his Diploma of Education from Wollongong University in New South Wales, Australia. Brad is also a proud representative of Peak Group Realty, brokerage and founder of GiveBackHomes.ca, a brand of real estate that donates a portion of proceeds to charity of the seller's choosing for each listing. Thank you all for being here, and I'll let you take it away.
All right, thanks so much. I'm just going to share my screen here. Just, can I just confirm, Chris, you can see the screen?
Yep, everything looks great.
All right, sounds great. Thanks so much. So just want to start off by firstly thanking Brock University for having us today to present this first time homebuyer seminar. It's always nice to be able to give back to the Brock community. Before I get started, you might hear some construction. I thought I'd come to the branch to present, given the fact my wife's home with the kids. But turns out there's some construction going on. That was unexpected, so don't mind the background noise. So going into our seminar, when we put this seminar together, we kind of thought the best way to structure it is if we structured the seminar in a very similar fashion to how you'd probably go about planning to buy your first time home. So I'm going to talk a little bit about maybe the process you might expect to receive from your financial advisor in terms of planning for the down payment for your home, as well as some of the government grants and programs available to first-time home buyers. And then typically once you have that meeting with your financial advisor, your advisor may recommend you meet with a mortgage specialist who can kind of guide you as to how much you'd be eligible to borrow given your income, kind of go over those details. And then once you check off those two boxes, that'd be the point you'd probably go meet with a realtor to put together your first time home buying strategy and kind of get an idea of what you can afford and the best strategy to go about that. So with that being said, I'll move into some of the tips that we typically recommend to our clients on how to start saving for your down payment. So one of the first ways we always recommend is a pay yourself first strategy. So setting up some sort of systematic plan that you contribute to an investment. And we typically recommend doing this and aligning it with your pay. So if you get paid bi-weekly, as soon as your pay comes in, have a specified amount come off and have that reoccurring. So for example, if you were to contribute $100 a pay over a bi-weekly basis, that's $2,600 in savings per year. The nice thing about this is once you get used to it not being there, you don't seem to miss it. It's just usually the first month or so shock of not having it there. The next recommendation we have is to kind of look at your budget and see if there's anywhere you can reduce your spending. Now, I get the fact that cost of living is very, very high. The cost of rent is also high. So when you design your budget and look at your spending, you're probably going to find there's two different types of expenses. You have fixed expenses such as rent, car payment, cell phone bills. They're fixed in terms of you can't really change them very much. However, then you have your discretionary spending. That could be groceries, any extracurricular activities and spending that you may have. Those variable expenses, those are variable expenses, and they tend to be the ones that you might be able to find some savings. So one example I'd like to give is if you're buying perhaps a $5 Starbucks coffee or drink every day of the week, if you were to cut that back to only maybe once a week instead, that would be an easy way to find about $1,560 a year in savings. So just little things like that could really help with your savings plan. The next item we typically talk about is taking a look at your debt that you may have and seeing if there's a way to consolidate it. And what I mean by that is, for example, if you had a $10,000 credit card at 19%, if you worked with your financial planner or advisor, you may be able to find out that you could turn that from a variable product. And what I mean by credit card, it doesn't really have an end date and you're paying a considerably high interest rate. You may be able to switch that into a fixed loan at a lower interest rate, but it would also have an end date. So you may be able to do like a 5-year loan at a reduced rate, which would end up A, giving you an end date, and B, saving you the amount you're paying in interest. And then the fourth topic we usually talk about is starting now. The power of compounding is huge. So even if it's a small amount you're contributing, starting that up on a recurring basis, you'll be surprised at how fast that will add up. It definitely doesn't take long to start adding up that savings, but you got to start now. It's kind of the key. And then you can always change what you're contributing as your income goes up or your situation changes. Now, when we are looking at where would you put your savings, the two typical plans that we're recommending is either Rrsp, so Registered Retirement Savings Plan, or a tax-free savings account. And I'll briefly just touch on the differences. An Rrsp, the benefit of that is when you put money into Rrsps, you'll receive a tax deduction for the amount you put in. And while the money's inside the Rrsp, it'll grow on a sheltered basis. So you don't really pay any tax on the earnings while it's inside the plan. However, when you take that money out, that's when you would start to see some taxes being paid on it. Now, the Tfsa, the tax-free savings account, it's after-tax money that you're putting into this plan. So there's no tax deduction when you put the money in. However, whatever growth you see on your investments, you don't have to pay any taxes. And when you do a withdrawal, they're not taxed either. So what I normally suggest is if you work with a financial advisor or planner, they'd be able to kind of guide you as to which plan would be most suitable, or perhaps it's a combination of both. So now I'll move into some of the government home buyers programs that are out there. And the first one being the Rrsp home buyers plan. So what the government allows you to do is, if you're a first-time home buyer, you can withdraw up to $35,000 from your RRSPs to put towards the down payment of your home. There's a couple of rules with the plan. To be eligible, you have to have the funds inside the RRSP for at least 90 days or 3 months before you do the withdrawal. So you can't just simply put the money in today and withdraw it tomorrow. If you did that, you would have to pay tax, unfortunately, on that amount. The other rule is you must withdraw the money within 30 days of owning your home. I would think most people would be using the money for their down payment, so chances are you'd be withdrawing that money before you buy the house. But if you don't, make sure you do it within 30 days of owning your home. Now, you typically have to be a first-time home buyer. There is a couple instances where you could take advantage of the program even if you weren't. And those two situations would be if you're recently separated, or you claim the disability tax credit, or potentially buying a house for someone who has a disability tax credit. I'd say if any of those situations, if you're in any of those situations, I would recommend speaking with your advisor to just double check that you qualify. The other component of the plan is whatever amount you withdraw, you have to recontribute it back to your RSP starting the second year after the year of withdrawal. And it must be paid back over a 15-year period. So it's important to note that, because if you're doing this and you have a new mortgage, so extra expenses to pay for, if you take advantage of the $35,000, you would have to contribute about $2,333 a year back to our RSPs. And if it's you and your spouse doing it, yeah, it could become a bit of a burden to meet that obligation every year. So you definitely want to make sure that you can fit that into your budget before doing it. The next program is, and this one's relatively new, it was introduced in the 2019 federal budget. It's the first-time home buyer incentive. This program is a government program. There's a lot of moving parts to it. So I'll try to explain it the best of my ability. So how it works is, if you're buying a home, you're able to get a second mortgage basically from the government for either 5 or 10% of the value of the home you're buying. And it must be repaid in at least 25 years, or if the property is sold. I'll go through a couple of the rules. There is a lot in here, but we'll just go through some of the relevant pieces. In order to qualify for this incentive, your annual income must not exceed $120,000. They have increased that to $150,000 if you live within Toronto, Vancouver, or Victoria. The other rule is the total borrowing cannot be more than 4 times the amount of your qualifying income. So for example, if yours and your spouse's income or your income is $100,000, your mortgage could not be more than $400,000. Or if you live in Toronto, Vancouver, Victoria, that would be $450,000. Either if there's 2 people buying the home, at least one of you has to be a first-time home buyer. You must be a Canadian citizen, a permanent resident, or a non-permanent resident who's authorized to work in Canada. And you also must meet the minimum down payment requirements with traditional funds. So Tina will be going over the down payment requirements, I believe, in greater detail, but you have to have your down payment. So this is more of a complement to your down payment and in hopes to reduce the mortgage you need. And if your mortgage is smaller, then so would your mortgage payment. So it's just trying to reduce your monthly obligation, I guess, is what the plan's intended for. Now, since there's so many moving parts, I find the best way to explain the program is by showing you an example. So I just put together a simple example of a first-time home buyer who's buying a brand new build home. So they're qualified to receive 10% of the purchase price or the mortgage. So in this case, they're buying a $400,000 home. They have a $20,000 down payment set aside. They apply for 10%, so $40,000 of a shared mortgage. Now, this, in fact, will reduce the mortgage that they're required by $40,000. and will save on your monthly mortgage payment. The savings in this situation would be approximately $200 a month. And in this case, let's say you sold your home 10 years later for $500,000. This would basically result in you having to pay the government back 10% of the value of the home, which would be $50,000. So you can kind of see how this is a shared equity program. So the government actually has a 5 or 10% interest in your home. So you can't really sell the house without paying them back. There's a couple other things to note. There's no possible way to pay back a partial payment of this program. So you either have to give them the entire amount back, or when you sell your house, or if you hit the 25 years of owning your home, you have to pay it back. And then just looking through the program, I noticed there's 2 other triggers that could cause you to have to repay back this incentive. And one would be porting your mortgage. So if you wanted to, in that case, move your mortgage from one financial institution to another, that would be a mortgage port. That would trigger repayment. Another important topic is, let's say you want to buy out the joint holder. So you and somebody else bought a home. Let's say it's a husband and wife, and there's a separation there, and one person wanted to buy out the other person. That would be a triggering event. You'd have to pay back the first-time home buyers incentive. With it being a new program, the government's always reviewing it, and there's been some news headlines recently that the government may propose some changes to this program. And one of the things they're considering is, rather than it being them holding equity in your home, they might turn it into some form of loan with a specific interest rate attached to it. But the only thing I could recommend is to keep an eye on the program, and more than likely in the next federal budget, we'd see a change. Another first-time homebuyer program is the land transfer tax rebate. So when you go and buy a new home, you do have to pay tax on it, similar to if you're buying something at a store. Luckily, it's not 13%. It's substantially less. And the government realizes that there's a lot of costs associated with buying a house. So they basically provide a rebate of the first $4,000 of land transfer tax. So if you're buying a home for at least $368,000, you'd qualify for the maximum rebate. A couple of things to note here is, if you're buying a home for more than $368,000, so let's say $500,000, you still would have to pay some land transfer tax, but it'd certainly be a lot less than not having this first-time home buyer rebate. The other thing to note is, there's a lot of instances where you might buy a house with someone else who already owns a home. For example, your parents may go on title. So if one of your parents went on title with you, you're a first-time home buyer and they're not, you'd only qualify for 50% of the rebate. So $2,000 of a rebate rather than the $4,000. One other credit we have is the first-time home buyers credit. When you buy a home and you're a first-time home buyer, it's important to note that when you file your tax return for that year, you can claim this credit on your income tax, and it's worth about $750 to you. So I know it's not a whole lot of money, but definitely something to note. If you don't know that, you could easily miss it. And this would be the same thing if you were buying the house with another person who wasn't a first-time home buyer, you'd qualify for 50% of the $750. Or if you're buying it with another person who was a first-time home buyer, each of you would get half of the $750. And there's also been some talks around the government potentially doubling this credit. So keep an eye out for that. And that concludes my presentation. So I'll hand it over to Tina to talk to you a little bit more about mortgages.
Thank you, Kyle. Great information, so thank you. And I just want to thank Brock and everybody here today for giving me the opportunity to talk about your biggest purchase ever, which is going to be your first home. Sorry, I'm just going to start from the beginning here. I have a slide presentation, but for me, Chris, can you just confirm you can see that?
No, I don't have you sharing your screen just yet.
Oh, okay, hang on.
Perfect.
Yeah, you're good? Okay. Okay. So I wanted to talk to you guys today about sort of the process on getting approved for your first mortgage. So after you've met someone like Kyle, and now you know where your down payment is going to come from or be made up from, you're going to want to find out how much you can actually afford. So for qualifying for a mortgage, we are going to look at all of your reportable income. So are you working full-time? Do you have 3 part-time jobs? Maybe it's a combination of both. You're going to need to bring in your documents to your financial advisor or your mortgage specialist. And what we're going to be looking at specifically will be your current T4 from your employer. So if you have multiple employers, you're going to have to bring in all of your T4s for all of your employment. If you are part-time or have variable income because you're hourly and your hours vary from week to week, likely you will need to have your previous T4 available. You'll also need to have your current notice of assessments and a current pay stub. And if you haven't been on your job for a minimum of 2 years, you'll likely be asked to provide a letter of employment. We're also going to be looking at your bank statements. So if you bank with another financial institution from where you're looking at applying for your mortgage, you're going to need to bring in your 3 months bank statements. You're also going to need to bring in your proof of your down payment. So this can be in the form of your Rrsp, your tax-free savings account. It can be in a regular savings account or high interest savings account in your checking account. The most important piece of this is that it needs to be in your account a minimum of 90 days prior to your funding of your mortgage. The reason we do this is for FinTrack purposes. So we don't want to see a wire coming in a week before you're closing. It's very specific that those funds need to be in your account for a minimum of 90 days, and you will have to show proof of that. Your down payment can also be gifted from mom and dad or immediate family. So immediate family, mom, dad, brother, sister. It cannot come from an aunt or an uncle or your best friend, okay? Your down payment should also include, I know Kyle had a slide there that showed the different percentages for your closing costs. As a rule of thumb, we use 1.5% of the purchase price as your closing cost. So ensure that that is also in your account for 90 days, showing that you have the ability to close your mortgage. As a first-time home buyer, as Kyle mentioned, you will get that credited back, but we want to see that you have the means to do that prior to that rebate coming back. So although it's going to be, I have a little bit of a pushback sometimes where people will say, well, I'm going to get that credit back. We still want to see that you have the means to close that house, okay? Once I start a credit application, your credit bureau is going to come into play. And this is a big piece of your interest rate and how much you're going to actually qualify for. So if you can imagine a pie, the credit bureau is broken down into 5 components. The 2 most important components would be your credit utilization as well as your payment history. So 30% of that pie is made up of your credit utilization. And this is the measurement of how much of available credit is being used. So And 35% would represent your payment history. How do you repay the credit that you already have? So slow payments, missed payments severely impact your credit score. Sometimes I will see people that have not paid their credit bureau, their credit card as an example. Their cell phone bill as an example. They've switched from Rogers to Bell and they think that that's not going to affect their credit, and it actually does. So I would say be very mindful of your credit, how you treat your credit, and have an idea of what your credit score actually looks like. Sometimes if you have what I would like to call colorful credit, so some blemishes on there, some slow payments, your credit is at capacity, meaning your limit is $1,000 and you owe $1,000, it might be time to reevaluate, do a debt consolidation, as Kyle also had mentioned, and convert those payments into a one loan with a term and a more favorable interest rate. There are two types of mortgages that I'll talk to you about today. Just see if I can. I'm going to just stop it here. There's going to be two types of mortgages I'm going to talk to you today about. One is going to be the high ratio mortgage and the conventional mortgage. So I'll start off with the high ratio mortgage. With a high ratio mortgage, there are a little bit more guidelines that you have to fall within. So the high ratio insured companies ask that you have a minimum of 2 trade lines or 2 pieces of credit. So whether that be a line of credit, a loan, or a credit card. In some instances, they will require you to have a minimum credit score of 680. That would be your beacon score, if you've heard that terminology before. If you are looking at purchasing a home under $500,000, you can go in with as little as 5% down. If your purchase price is going to be more than 500, you will have an additional 10% required for the house value over 500. And this program for high ratio mortgages is capped off at $1 million. Okay. If you already have a home or are thinking of a summer cottage or a secondary home, you can still purchase these at 5% down. You will also need to qualify at the government stress test, which is now 5.25% or 2% over the posted rate, whichever is higher. When you go with the least amount of down payment, so the example of 5% down, you will have the highest premium added back onto your mortgage from the high ratio insured, which would be 4% amortized over 25 years. You will also look at selecting a term. You can have a term from 1 year right up until 10 years. This means that when your term is done, has expired or matured, you will need to renegotiate a new mortgage. If you look at doing a 5-year term, you will need to do this 5 times throughout the life of your mortgage because the maximum amortization for a high ratio mortgage is 25 years. High ratio mortgages also, they offer unique programs such as Purchase Plus improvements. So when you have an opportunity to speak with your realtor next, and you might find this house that you absolutely love, but you cannot live with the kitchen. High ratio mortgage will allow you to do a Purchase Plus improvements and get that renovation done within that mortgage. The other program is New to Canada program. And then they also have a spousal buyout program. So if there is a marital breakdown, you can look at taking your mortgage back up to 95% loan to value. There is actually no gray area when it comes to high ratio mortgages. So in this slide here that I have as an example, you will see GDS and TDS. So your ratios will have to fall in line in order for you to qualify for a high ratio mortgage. Your maximum gross debt cannot exceed 39%, and your total debt servicing would not be able to exceed 44% of your income. In a conventional mortgage, you're going in with at least 20% down. You will not have to have any premiums paid, and you can actually stretch your amortization out to 30 years. So if you wanted to figure out what you might be able to afford on your own, there are multiple mortgage calculators out there. You can go on to your financial institution and see what your mortgage rates are being offered to calculate the payment. And in this example here, we have your gross monthly income of $5,833.33. When we talk about gross debt, for me, that is primarily your shelter costs. So we're talking about your mortgage payment, your interest, your property taxes, and a very small heating component. You would have the total there divided by your monthly income, and that's how you're going to achieve your gross debt ratio. When we look at your total debt ratio, that would be your shelter cost plus any other financial obligations you would have, be that a car loan, credit card, credit cards, any revolving credit that you have. It will be calculated at a 3% of the outstanding balance. So not what your credit card company says your minimum payment is. In this case, it was $15, but it's actually 3% of the outstanding balance. So you'll take that total plus your GDS, your shelter costs, add those together, and you're going to divide that by your gross monthly income to figure out your total debt servicing. So in this example, we're well below the 39% for your GDS and 44% for your TDS. Okay. I would say sitting with your mortgage specialist gives you a better understanding of how much you're going to be able to afford, and what in some cases you might need to hold off on making that purchase, maybe saving up a little bit more for your down payment. Perhaps it is paying down some of that debt before you move forward. And having a plan in place is always key. Some tips that I would say as far as additional costs that you may not be aware of is that if you purchase a home and you pay over listing price, the moment you go over $10,000 of your MLS listing price, this will trigger an appraisal to determine the value of that property. You may also have a home inspection. That again is an additional expense that you would need to cover off. Your land transfer taxes, again, when I'm calculating your credit application, I would be looking at 1.5% of your purchase price. And then you will have your lawyer's fees on top of that. Again, just because you bought your first house with 5% down, you're ready to move, does not mean that you cannot purchase your second home with as little as 5% down. Some people feel that once you buy it once with 5% down, you have to go in with 20% the next time around, and that is not the case. The other thing too is that a lot of people think that just because there's a house for sale that it is actually mortgageable. Some houses are not. So I would caution you to look at working with your realtor, working with your mortgage specialist, finding out what you qualify for, because pre-approvals in my world do not mean that you're approved. It simply is a rate hold. And a rate hold can be done for 90 days. So now that you're comfortable with how much you're going to be able to afford, it's time to enlist the expertise of your realtor. And I would like to now pass it on to Brad Martin.
Thanks, Tina. Hi, everybody. I am so very excited to get this opportunity to speak to Brock graduates and current undergrads. Just a huge, just really, really great opportunity. And again, I'm with Peak Group Realty. I started getbackhomes.ca to try something different and to try and bring some money back to the Niagara community. So I understand that I speak most passionately about something. I'm sorry, I'm a little nervous, but something that you're both knowledgeable and passionate about. So for me, that was always basketball. I played in Canada and I played in Australia, and then I coached. So I coached Special Olympics, and that was the most important experience in my life. Now what I try and do is coach people through real estate decisions. So I'm going to get my slides going now. I'll make sure with Chris that we can see that in a moment. How's that?
Perfect.
Okay. Okay, so the first thing that I'm going to go over is something I call apples to apples. I'm going to paint a little bit of a hypothetical story here. Stacy, a Brock graduate, was born in a 2-bedroom apartment. By the time she was 2, she was moved to her forever home via her parents. I'm going to look at where that came from. Her parents, her dad did an apprenticeship, had a full-time job at 21, and had split a 2-bedroom apartment with his friend and was able to save a good chunk of money each month. Okay, sorry guys. Stacy's mom went off to nursing school and was a full-time nurse by the time she was 22. So they spent a couple of years in that apartment, and then they looked for a bigger home because they wanted to start a family, a bigger family after having Stacy. They had a lot of money saved, and they were able to buy a 4-bedroom home in a safer neighborhood. They purchased that house in 1989 for $180,000, and later sold that house for $650,000. Sorry, guys. Anyhow, so they made that $650,000 after a huge boom in real estate. Stacy looks at their home that they purchased. The next one was a bungalow, and she wanted to live right beside them. The thing is, that's not so simple these days, and that's not really an apples to apples comparison. Stacy's parents, they had kind of more opportunity. A better comparison would probably be Stacy's grandparents. They immigrated to Canada, and they had very little prospect in buying a house, and they needed a full-time job. They had a lot of help from their family and friends, and after a while, were able to save up years and years. And we could all learn a thing or two from that generation. If they could do it, grandparents and the like, and so can we. Now I'm going to jump into buying versus renting. I'm sure you've all had somebody tell you that buying a home is the best thing that you can do. But we're not going to buy into that ideology. I'm going to kind of explain both scenarios of buying versus renting and some pros and cons. Not so much in urban areas, but in Niagara, there's a little bit of a stigma against renting. That's really not needed because it's really the most viable solution for some young and old people looking for homes. So before we get into buying versus renting, pros and cons, we're going to look at some more realistic costs of home ownership. First, you have the upfront cost. This is the initial amount of money needed to buy a home. This could be down payment, deposit, closing costs, and applicable taxes. So often buyers are caught off guard here because they're not expecting the amount of money they need ready for legal fees, deposits, and things of that nature. You have ongoing costs. So it's one thing to save up enough for your house and your down payment, but then you have to earn enough money to pay for things like your mortgage, your property taxes, your insurance and utility bills. So one of the mistakes made here is when people buy a new home, oftentimes the taxes haven't been assessed yet. And when those come in, it can be a real shock. So that's one thing to be ready for. The last thing, realistic cost, is the major repairs. So both with new homes and resale homes, major repairs are unavoidable. Unfortunately, you have roof replacement, foundation repair, heating and cooling costs. So if the buyers kind of reach for the moon, so to speak, with their purchase price, they may be in a tough spot when it comes to major repairs. We're going to look at those pros and cons now. So for renting, some positives: you have less maintenance and repairs. You have lower monthly and upfront costs. You know, for Brock graduates, you have a shorter term commitment. You have, if you have an opportunity arise, you should be able to get up and go in a couple of months' time. And you have the protection from the decrease in property values. Some negatives there is your monthly payments might go up year after year. One of the big ones is if your lease does not get renewed. That can be scary. You are paying somebody else's mortgage rather than building equity of your own. You can't paint or remodel without a builder's permission. Sorry, a landlord's permission. Then with buying, some positives there is you can do that. You can renovate or modify as you please. You're building up equity in a safe investment. You have potential for rental income. Let's say you want a secondary suite there. And you have the peace of mind of owning the place where you live. Some negatives there are the risk of financial loss if your home loses value. You're responsible for those ongoing costs and the repairs that we talked about. And the monthly payments could increase significantly if the interest rates go up at renewal time. Sorry, guys, just a quick second, seeing that I didn't progress my slides. Okay. Okay, so now we're going to jump into the home buying process. So a lot of you will ask, and please ask extension questions, why houses, the price of houses went up during the pandemic. It was expected to go down, but we didn't know what was going to happen with the pandemic, and they didn't really correctly predict what was going to happen with prices. We can look at foreign buyers, we can look at large scale investors and flippers, people from the GTA moving to the Niagara region, but really the biggest thing there is inventory. So a lot like lumber, if any of you were doing projects, or building supplies, that went up 230% compared to pre-pandemic pricing. And we also saw houses in huge demand as the supply was low. And in Niagara, some of those houses went up to 40% compared to those pre-pandemic listing prices. So as a result, the home buying process ended up so much more competitive. And I'm going to coach you through how to win in a competitive market. The first thing that I have to suggest to you, and I know we did hear from Tina, is getting pre-approved. It is so important, yet it is overlooked very often. Oh, not just yet, Brad. So why is it overlooked? People using mortgage calculators, these are basically just clickbait. These are really doing you no true favors. They do not do a full calculation, and they're not accurate. The other thing is, if you're really budget savvy and you're really good on Excel, well, you might think you're doing all the right calculations for your budget, but the fact is a mortgage specialist like Tina is going to do so much more, and certain amounts of your income might actually not count as income. You might need different types of guaranteed hours and employment letters, or that 2-year average that you talked about. So getting pre-approved, I compare to having a crystal ball. It eliminates a great deal of potential stress and heartache. The last thing you want to do is commit to a really long house search and then scramble to get your financial documents together with a mortgage specialist you hardly know and cross your fingers on the home that feels like the right one. So you trusted your doctor. If you trust your doctor, if your knee's hurting, you go to the mechanic. If your car is breaking down, you go and see someone like Tina when you need a mortgage. And now it's time to call a realtor. So when you're picking a realtor, I have to suggest somebody that's going to get you a desired result while maintaining transparency and care throughout. A personal goal for me here is to have a shared vision. It's not about what I want, it's really about what a client wants. And the sooner you can understand and document your client's vision and make it your own, then you are going about things the right way, and that's a realtor you want. If anybody's motivated by simply the commission, then the house that rewards the realtor most financially will be the one they're most interested in, when you should be looking for the house that brings your clients the most joy. So once you've been pre-approved and you've established who you're going to be choosing as a realtor, here are some helpful suggestions. So establish a time with your realtor that all the decision makers can be there. This is a big term in real estate, decision makers. This is everybody that needs to have that seal of approval. So not just having a time carved out for the realtor and for you each week, but making sure you're all there and not just some of you. Keep track of the listings you go out and see. Sometimes that very first listing you see is the first showing you go to doesn't seem like much, and you might forget about it, but comparing it and knowing it well is going to help you and serve you well in the long run. Be vocal in your showings. Don't just talk to your partner or whoever's there with you in terms of decision maker, but also your realtor. If the realtor knows exactly what you're looking for, the quality of that search is going to be that much better. This one is really tough. Envision each house as your own. So you're going to go through houses that may have clutter, may be decorated in a way that you don't like, may have really distinct smells. And my suggestion to you is to look past that and think about what you would make that home, whether it be as simple as paint colors, or you step into taking down a wall and improvements. Take your time. This is really, it sounds simple, but it's so important. Take your time and look for the right things. If you have a friend or family member that can go with you, that's really knowledgeable about houses, take them with you. If that's going to bring you peace of mind, maybe they'll look a little bit further for signs of water damage, potential problems with the roof or leaks. And the other good thing is when you're with a realtor, they have a duty of diligence and integrity towards each other as well. So if I'm to ask the listing agent a question or a follow-up from you, the home buyer, they are obligated to find that information to the best of their ability. The last thing there is finding out the offer instructions. So it's been really competitive. A lot of people are holding offers for 3, 4, 5 days, and that may make you want to prioritize to see that house more quickly. So here's a few things now before submitting your offer, some recommendations that I have for you. So ask your realtor to investigate further and compare that the home there to houses within a close radius. A big word for real estate and for judging pricing is precedent. If a home sells typically for $500,000, and then 6 months later, the neighbor sells for $570,000 and another neighbor sells for $620,000, well, you can be sure the third person to go up is going to be expecting prices similar to those last two. This is going to help you within your budget to determine what to offer. Now, deciding on the terms and the conditions with all the decision makers. So more than just the price here, you need to have terms and conditions that you agree with. Let's say one of you wants a home inspection and the other doesn't. You have to come to an agreement on those before putting an offer together so that you're at peace with that. This one here is usually eye-opening. It's making sure your realtor is representing you with an accurate offer. It needs to basically be bulletproof. So an example of this is if your realtor simply puts the word fridge on your offer in terms of the chattels included, well, the seller is only obligated to give you a fridge and not necessarily the fridge. That was what you saw in the showing. The other example is if the realtor doesn't put into terms or wording the type of condition the house has to be left in. There is a term called broom swept condition that we use. The seller might leave a huge mess or large ticket items that could actually cost you thousands of dollars to clean or remove. Lastly, in that section there is understand that your offer is binding. So once you've submitted an offer, you're actually contractually bound to the listing and to that offer until it's accepted or rejected. This can take between 12 or 48 hours to hear back from the seller. During this time, you can't submit another offer, and it really wouldn't benefit you to continue on your search. You also can't back out of your own offer. Okay, So let's get into some competitive strategies. Without these strategies and without evolving in this market, it's really, really tough to find a home. The first thing here is make sure you're seeing all listings immediately. After you've seen Kyle, after you see Tina, and you know you're ready, and you call someone like me, make sure you're seeing everything. So this is going to be a Realtor tailored search. Also Realtor.ca. Any way possible you can stay in the loop, because the last thing you want is to feel like listings are coming up within your criteria without your knowledge. See a mortgage specialist. Again and again, I keep stressing that. Just make sure you're fully prepared and you're pre-approved. Consider what the seller's wants are. This might seem, I know we're in a seller's market, we do have to respond to these things. So if the seller might be an older couple in their 80s and they have something, a large ticket item that's really hard to move, well, if it's easier for you to move, you might include in your offer or in words that it can stay there. This could also be closing date. You can ask your realtor to find out what their preferred closing date is, and it gives you a little bit more of a chance to secure that home. Leave an impression. This might sound silly, but I have had sellers really respond to this. Write a brief letter when you're submitting your offer, potentially including pictures. Let the seller know their home is in good hands. Let them know it's not a flip investment. You might love it just the way it is, and that means something to somebody. You might also let them know the strength of your financing, not with numbers, just with words. Let them know that there's some flexibility there and that you hope that they'll work with you. This one here is really great. Consider a second showing with a home inspector. This happens all the time. It's something I do often, and it really helps people. So if you can get back in through that house with the home inspector, if you have 5 days of showings and you went the first day, you might be able to go back with the home inspector. It sounds costly, but it can save you so much money in the long run and might keep you from putting an offer in on a house that was an absolute lemon. Consider a preemptive offer. Preemptive offers or bully offers get a really bad reputation, but you have to explore every option possible. So a preemptive offer is when you submit an offer before that offer presentation date, as long as the listing agent and the sellers will have it. This can actually save you thousands of dollars sometimes if you're not competing with 10, 20, and even up to 75 offers. So important here, if anybody's watching Ted Lasso like me, be a goldfish. Do your best to submit that offer knowing it's just an offer. And if it's not accepted, to move on to the next one. If you have a 3 to 4 day hangover, so to speak, of not getting that offer accepted, you might very well lose out on something that was the best option for you and within your budget. Okay. So once your offer is accepted, you're not quite done yet. This is where you want to be making some lists and in close contact with your realtor, as you still have a few deadlines and things to note. One example of tying loose ends is that your deposit is due within 24 hours of an accepted offer, and you need to get those details sorted out basically as soon as your offer is accepted and as soon as business hours are open. If you were able to get an inspection, refer to it. You may even want to consider getting an inspection after you've taken the home on the closing date. So this happens. Let's just say you purchased a new build, but the grading beside the house was not quite to spec. Well, it could save you a lot of money if you knew that firsthand and you modified that as soon as possible. The other thing is when the house is yours, your relationship with your realtor is not over. An involved, caring, elite realtor is going to guide their clients as time passes. Should they need a document, a suggestion, or a contact. I'm always loaded with contacts for everything from renovations to services at the house. So definitely that relationship is not over. Okay, last but not least, and Kyle touched on some of these, and I'm just going to go through these briefly, is the Liberals were elected. So how does that affect you? So first and foremost, this one is a lot of buzz right now, is the Home Buyers Bill of Rights. So some highlights there are they are banning blind bidding. Blind bidding is not knowing what others are offering, not knowing if you are the high or low offer. Establishing a legal right to a home inspection, increased disclosure and transparency from realtors, and ensuring banks and lenders offer mortgage deferrals in the event of job loss or major life event. I think these are positive, and I think that the blind bidding, doing away with it, we'll have to see how that goes over time. I think it still favors somebody with a buyer that has more flexibility. So we'll see how that comes through in the end. And I really like the peace of mind knowing that the lenders will have your back if there's job loss there. Then there's the rent to own program. So the government is going to be committing $1 billion to loans and grants to help develop and scale up rent to own projects with private and not-for-profit and co-op partners. So people that are looking into building those co-op buildings and to building more affordable homes, they're going to actually secure those loans for them. Reducing monthly mortgage costs. This is something that would be really helpful. These are all stated. We're hoping that they come through with these. This one will be really helpful. So the Liberals have said that they'll reduce the mortgage insurance cost by 25%. So if we're looking at the life of a mortgage and the average price in Niagara, it would save you $6,000 over the full life of your mortgage. Okay, affording a down payment faster. So this is another thing here. This is a program where first-time home buyers under 40 will be able to have an account that they can withdraw from up to $40,000 without tax implications. Hopefully some of this was helpful for you. If you have any questions, reach out anytime. I am going to be putting some helpful resources in the chat there now. And I just wanted to thank you so much for your attention, getting through my nervous moments there. It's been a little while. I'm sure not too many have had too many public speaking opportunities with the pandemic and that, but please reach out anytime if I can help you. I'd love to help Brock you. Thank you so much.
Awesome. Thank you so much, Brad, for your presentation. That was great. And thank you to Kyle and Tina as well for your presentations. I'll just stop sharing screen here. Perfect. All right, so there was just a couple of questions. I know we're pretty much over time right now, but I thought if ever anyone wanted to throw in a quick answer to these few questions, that'd be awesome. Dawson asked, how does home equity work? Is there anyone who wants to explain the concept of home equity and how that works?
Let's see. Am I still on?
Yeah, you're still on, Brad.
Okay, so we might be able to help each other out here, but home equity is going to be the portion that you've paid off of your home through your mortgage payments, through your down payment and deposit. That's the equity side you're building. Let's just say you buy a $500,000 home and you have a $40,000 down payment. You might have an additional deposit of $10,000. And then after a few years, you've paid off $10,000. So that 40, 10, and 10 is $60,000 in paid equity. Now that's, you have $440,000 remaining and the equity in the home becomes that 60. I would love to hand it over to Tina. She'd probably be quite an expert on it as well.
Yeah, so I would say for right now, with the way that the housing market has gone, you will likely see that purchase that you made probably a year ago has actually gone up in value. And what we can look at doing is we can lend 80% of the value, the appraised value of your property. So you can take that mortgage back up to 80% of the value. You need to remain your 20% down in that property. And it can be either you can do it as a loan, you can do it as a home equity line of credit. Really depends on your situation and what you're going to need your funds for.
One other thing I'll contribute to, Dawson, is equity is essentially if you sold your house. So if you sold your home for $500,000 and there's a $100,000 mortgage, what you're left over with, the $400,000, that's your money. That is the equity that's left within that home. That's essentially, if you're looking at your net worth, You have your asset minus your liability leaves you with your equity at the end of the day as well. Just if you're trying to figure that out in terms of what does the word equity mean in terms of homes, that's kind of another piece to consider.
One more thing, Chris, and sorry, Dawson, we're probably throwing too much at you, is a lot of people are thinking about one purchase and then moving on to the next. And I have a lot of investors kind of going that way. But it takes a little while to build some equity in that house through payments and through down payments. You won't really be pulling from equity of one house onto the next one too quickly. It does take some time and some payments that are kind of get you in a positive situation that you can go and see someone like Tina again for the next mortgage.
So if I buy a house for $500,000, I put a $40,000 payment in, the bank gives me an 80%, they lend me 80% of the value, and then I still have to keep 20% down, and then there might be $40,000 after a certain amount of payment is paid, and then that is equity, like it's like a profit almost.
Well, I would say it depends on what you're looking at as far as equity. So both Kyle and Brad talked about more so your down, your payments down, and your mortgage payment and your down payment, and then that's building up your equity. What we've seen recently with the house pricing is that there is a built up of equity, not by you paying down your mortgage, but by the value of the property going up. So it depends on what you're looking at doing, right? So if you're looking at selling, and then like Kyle said, you will be pulling the equity out of your home, that is your profit per se. If you're looking to refinance because you want to pay off debt, or you want to have a home equity line of credit because you want to look at doing some renovations down the road, then that's the equity you can pull out of your house based on the value of your property.
Thank you.
Yeah, you're welcome.
Thank you, Dawson, and thank you for sharing your video with that most epic mullet. That is very impressive. So the next question we had here was from Christine, and this might be more a question just for Kyle. Christine asked, if you purchase a home with a spouse who's a first-time home buyer, but you are not, can you still take advantage of the perks of the first-time home buying together? I think you mentioned one of the programs you could, but if you could just elaborate just on all three of them that you.
Yeah, sure. So pretty much in every scenario, you can take advantage of it. Now the program's always changing, but you might only be eligible for 50% of the credit. So you that would just be the one thing to kind of consider. And there may also be a stipulation for the Rrsp component. There may be some restrictions on that one, but the tax credit and some of the other ones, there's no real issue that I can see there as far as the still being able to qualify, because the one person technically is the home buyer, so half is kind of what's eligible.
Perfect. Awesome. Thank you. And then another question I have is from Christina, who asked, for young people who it's tough to break into the housing market from a financial standpoint, is it better to go with a resale home or to enter a situation with a new build?
If I can jump in here, do your best to focus on resale. If you trust a home inspector, don't be afraid of resale. There's still a lot of time in these homes, especially if you're talking to a good realtor and home inspector. They're going to tell you kind of timing as to when the better homes were built. They'll tell you materials were different in the 80s, 70s, 60s, and 50s. So finding these things out and putting your faith in a resale home is probably going to bring down that total listing price, right? The cost of new homes right now, and if the materials is just too high, maybe as that settles, things will change. But for now, I would concentrate on resale homes as best you can.
I can kind of tie into that because mine and my wife's first home was a new build, and I don't know if I went back to it, if I would redo it as a new build, because there was a lot of hiccups. Hiccup number one was the date they tell you your house is going to be built. Chances are it's going to be extended. That's one hiccup. The next thing, if you're buying a brand new home, you more than likely, you'll need to buy appliances. Sometimes you get them, 9 times out of 10 now, though, you don't. You'll need to buy lots of other things for your house too. You might want to change light fixtures, garage door opener. We had to do a deck. Most of the time your basement's not finished. So there's a lot of additional costs associated with buying a brand new home that you may not have if you bought a home that's been built and in place for 3 to 5 years. You'll have some of those features already in there.
Perfect. Thank you for that answer, both of you. So I think we've got time for one more question from Josh. He's just said, if you have multiple RRSPs, can you take it from both or can you borrow from one? And is it just RRSPs or can you take from your tax-free savings account as well?
All right, so yeah, I can answer that. You can take from multiple RSPs as long as you don't go over the $35,000 limit. There's no issue there. As far as TFSAs, there's no restriction on TFSAs. You can withdraw TFSA money whenever you want, unless you're in some sort of fixed contract, like a guaranteed income certificate or something where it's locked in. But if it's just a savings account or an investment tax-free, you could withdraw that money and use it for your home whenever you'd like. You could also take your tax-free money and put it into an RRSP to get a nice tax deduction. Leave it there for 3 months before you decide to buy a home and then take it out. I've seen that happen as well. So just want you to know. Also, Tina just messaged me. Unfortunately, her battery on her laptop died. So she's left us.
That is really funny. Okay, well, that I think is the end of our session. Thank you so much to our presenters, Kyle, Tina, and Brad. You all did amazing. I hope everyone learned a lot. And as mentioned off the top, you can visit the university's homecoming hub to check out all the other events that are happening over the weekend. I think there's a paint night and a cookie baking tonight, and there's a bunch of events tomorrow, a 5K your way, and a community cleanup on Sunday. So lots of fun stuff to get involved with. Thanks again to everyone, and take care and have a good rest of your Friday.
Thank you, everyone.
Thanks so much. Bye.